Hello and welcome to the Iceberg of Economics, Part 6. We've only got two parts on the official iceberg before we get to Crazy Town. And this one is just about, we've had a common theme. It's like interesting ideas in economics, but have never really been tried. Yeah, that's kind of really the wrap on this, but let's get started. The first one is steady state economics. And steady state economics really is the idea that all things equal, if you have input the same amount of resources and have the same amount of people, you will get effectively the same amount of output. And the economist who's most notable for this is a guy named Herman Daly. And it's really, you have a constant stock of capital, a constant stock of people, and you maintain those similar levels through selective policy measures to make sure that the economy stays at the current state. The reason really for this is partially due to Daly's and steady state advocates' criticism of just consumerism broadly, and they feel like living standards are sufficiently high enough even back in the 70s when this first got drafted, and people should just be learned to live okay within their means, and as long as we don't have a decline from here, we should be fine. The second thing is just environmental concerns again. If you have the economy not growing, it means you're not increasing the rate of damage to the environment. And it's more practical than, say, the next term that we're going to talk about, which is degrowth economics, which is actually starting to cut and have a target of actually lowering the size of the economy. So it's kind of, I think of steady state economics as kind of like the moderate version of degrowth. It's just the goal is really just to kind of keep it the same, but it's also steady state economy is really just making an ideological platform to try to achieve a goal of the idea of ceteris paribus, all things equal. We use it as a theoretical example of what would happen if you did bring in an exogenous variable to change the current economy. It's the steady state, the default. It's the null hypothesis really in economics, but there's also a actual goal of creating a steady state economy. So it could mean both things. And speaking of that, next one we're going to talk about is degrowth. Degrowth economics is the idea that due to shortages in natural resources and environmental damage, peak oil, and the declines of megafauna and a lot of other real concerns, which is resource consumption in the environment, that the goal should not really be to grow the economy, but actually to shrink the economy and the damage and the consumption of natural resources of humanity. A more moderate form of this would be really, the goal would be to try to keep consumption the same outright in terms of living standards, but use technological innovation to use less resources for the same amount of goods and services. That's, I think, what most people who are advocating for degrowth, but more extreme advocates of degrowth want just outright just decline of the ecological footprint at any cost. And they say hey, we have to cut resources by X amount. It doesn't matter if you have to cut output if you can't do it in efficiency gains alone. Climate change or other environmental disasters are that dire, we don't have the luxury to be patient at a steady state. So really the debate in this field of the degrowth advocates is how fast to go about doing it, even though they all have the same end goal, which is to reduce the amount of resources being used. And it's also associated with a lot of other progressive causes, because apparently excess economic growth creates inequality, which I've talked about already with Thomas Piketty. But yeah, it's degrowth really hasn't been tried in any meaningful way. I mean, companies, of course, try to do it just to increase profit margins, but on a countrywide level, it hasn't. The main criticism, really, of degrowth is who are these policy elites advocating for it have the right to say how good of a standard of living is good enough. It's the same criticism of steady state. And there's also been a lot of positive benefits to economic growth. If it wasn't for economic growth, we wouldn't have a lot of cures for a lot of diseases, which a generation or two ago would have been an instant death sentence. Now you have longer lifespans because of economic growth. You have a lot higher quality of life due to things such as the internet, making all of our lives easier. Like if it wasn't for economic growth, you wouldn't be able to watch me summarize this iceberg right now, or even the person wouldn't be able to make this iceberg. You'd have had to find some obscure textbook at the library about each one of these topics. And if the degrowth people got what they wanted when this first started to become popular in the 60s and the 70s. And there's also a political component. If you are going to degrow, who eats the burden of that? Is it just the people who in your political opposition are the ones who are going to have to cut their living standards first? Is it going to be those who are historically disadvantaged or historically advantaged, or people who live in geographies that are more environmentally degraded than others? Like, yeah, the politics, a lot of it is just a measure of who eats the brunts of losses of change. And this would be no different. How would you decide that? But yeah, overall, that's what degrowth economics is. Next, we're going to talk about the Lange-Lerner model of socialism. It's kind of a way to add markets in the end user, but at the same time have the state own every business. So it would be in the sense that the state would own all the property and the means of production. There wouldn't be any private property other than like personal items in this world, but they would let business owners and markets set like the pricing and the desired allocation for goods and services. So if, for example, people all want to buy red umbrellas and the red umbrellas sell out, that's the market signal to make more of those. That the state-owned factory will supply what is demanded, and it'll use the market impulse to determine what end users actually want to buy. But they would still keep the communist model for public ownership and in terms of wealth redistribution and all of that. This has never been tried anywhere, and so we really don't know how it would work. A lot of it, the thing is that you would still, even if you have figured out what the market of demand, there'd be at best a lag. If at worst, the government will have no idea still how much to produce of quantities of goods and services, because just because some people want to buy one thing one week, they may not want to buy it the next. So you're going to always be a step behind. And also, this thing has never really been tested, and there's no really models or framework for it, so it would be hard. There's no way to falsify it. That's the other real main critique of the Lange-Lerner model. And also, what would be the incentive for these vendors to want to generate a Pareto outlook? If you're still going to have, you basically want the bet cake and eat too. You want the pricing power and the efficiency of perfect competition, but you want all of the social goals and the means of production controlled by the state, as it would be in a socialist economy. Those are fundamentally, I think, irreconcilable. The next real thing we're going to talk about is the inverted yield curve. which we're actually going through an inverted yield curve right as I'm speaking. It might actually become one of the longest inverted yield curves in the history of modern financial markets in the United States. And the yield curve is really just the difference in interest rates over time. A normal yield curve is positive sloping, whereas shorter term debt has lower interest rates than longer term debt. That should make sense because, say, if I wanted to borrow money from my friend and he doesn't trust the ability of me to pay back, or he has to be compensated for the time value of money that the longer I have the money. So therefore, he needs a higher interest rate to compensate for the credit risk of me not paying back, and also to compensate him for the time being locked up and the reinvestment risk of not being able to reinvest that money at a higher return at a future date. So that's why a 10-year bond historically would say yield 4% versus a 2-year bond would yield 2%. An inverted yield curve is when you have the opposites, when the shorter end of the curve is a higher interest rate than the longer end of the curve. So right now in the markets, you have the short-term rates at 5.5%, and you have the 10-year yield at 4%. So you actually are getting compensated more to lend in the short term than in the long term, even though in a normal market, you should want to demand higher interest rate in the future due to the risks I mentioned before. The reason why you have inverted yield curves is because yield curve inversion is anticipation for recession, and as a byproduct of recession, interest rates getting cut. So people will take a lower interest rate now to lock that in. So in the event that the Fed cuts rates and the whole curve steepens again through interest rates dropping, you'll still get that 4%. So say, for example, we hit recession, Fed cuts the front end of the curve from 5.25 to 2%. So therefore, there's people who own short-term debt. When they want to reinvest in short-term debt, they can't get the same yield. Whereas the 10-year will still drop, but it will drop from, say, 4.3%, whereas as I'm recording this, down to, say, to 3.5%. So it's still a positive sloping yield curve, but those people who locked in their interest rates did so because of anticipation of the whole yield curve dropping and steepening through. That's why a yield curve steepens during recessions, because of cutting of interest rates. That is why a yield curve inverts. And historically, there have been 9 yield curve inversions since the 60s, and 8 of them have resulted in recessions. So far, we haven't had one yet, but it's too early to determine. And the inverted yield curve is a strong sign of why I still believe there's a high probability of a recession within the next 12 months, even as a lot of the market consensus has gotten a lot more optimistic about the future trajectory of the economy. Next, we're going to talk about is Georgism. The next one we're talking about is ecological economics, which I think this is really essentially the same as environmental economics, donut economics, and green economics and degrowth. It's not exactly, but it's a similar idea that you need to factor in ecological considerations and negative externalities towards the environment. And then the last one we're going to talk about